In the winter of 1637, something extraordinary happened in the Dutch Republic that would echo through economic history for nearly 4 centuries. A single tulip bulb, specifically a rare variety called Semper Augustus, with its distinctive red and white striped petals, sold for the price of a grand Amsterdam canal house. Within weeks, the entire market collapsed, leaving thousands of Dutch merchants, artisans, and even ordinary weavers holding contracts for flowers worth less than onions. This wasn't just a quirky historical footnote about expensive flowers. Tulip Mania represents the first recorded speculative bubble in modern economic history, and understanding what really happened reveals uncomfortable truths about human psychology, market mechanics, and the fragility of economic systems that remain painfully relevant today. To understand how rational people convinced themselves that flower bulbs were worth more than houses, we need to travel back to the Dutch Golden Age. The Dutch Republic in the early 17th century was experiencing an unprecedented economic boom. Having recently won independence from Spain, the Netherlands had become the world's leading commercial power. Dutch merchant ships dominated global trade routes, bringing exotic goods from Asia, Africa, and the Americas. Amsterdam was transforming into the financial capital of Europe, with sophisticated banking systems, insurance markets, and the world's first true stock exchange. Wealth was flowing into the country at an astonishing rate, creating a new merchant class with disposable income and a hunger for status symbols that would distinguish them from their newly wealthy neighbors. Enter the tulip, a flower that had arrived in Europe from the Ottoman Empire just decades earlier. Tulips were exotic, beautiful, and unlike anything Europeans had seen before. But what made certain tulips extraordinarily valuable wasn't just their beauty, it was a virus. The mosaic virus, transmitted by aphids, created dramatic color breaks and patterns in tulip petals, producing those striking striped and flamed varieties that the Dutch called bizarden and violetten. These patterns were unpredictable and impossible to reproduce reliably through breeding. A plain tulip might suddenly bloom with spectacular markings, and these marked tulips would command enormous prices. The unpredictability itself became part of the allure. Tulip growing was like a lottery where your garden could literally bloom into a fortune overnight. The market for rare tulips began legitimately enough among wealthy collectors and botanical enthusiasts. Tulip bulbs could only be planted in autumn and would bloom the following spring, creating a natural scarcity and anticipation. Because bulbs multiply slowly, producing only 2 or 3 offsets per year, truly rare varieties remained scarce for years. By the early 1630s, a robust market had developed where rare bulbs changed hands for substantial sums. A skilled craftsman might earn 200 to 400 guilders per year. In this context, rare tulip bulbs selling for 1,000 or even 3,000 guilders were luxury goods, expensive certainly, but not absurd given their scarcity and the wealth of potential buyers. But something shifted dramatically in late 1636. The tulip trade transformed from a market for actual bulbs into a futures market for bulbs still in the ground. Traders began buying and selling promissory notes for tulips that wouldn't be dug up until summer. These weren't formal contracts traded on an exchange. They were informal agreements made in taverns, often written on slips of paper. The genius and danger of this system was that it allowed anyone with a small amount of capital to speculate. You didn't need thousands of guilders to buy a rare bulb. You just needed enough to buy a contract promising future delivery. And because tulips were still in the ground and couldn't be inspected, the trade became increasingly abstract. People were buying and selling pieces of paper, not flowers. This futures market exploded in what historians call the wind trade, so named because traders were essentially buying and selling air. Between November 1636 and February 1637, prices increased by factors of 10, 20, or even more in some cases. Common bulb varieties that ordinary people could afford suddenly became objects of frenzied speculation. A bulb of Witte Krunen, a relatively common variety, sold for 20 guilders in November 1636. By February 1637, the same bulb commanded 200 guilders, a tenfold increase in 3 months. Even more remarkably, people who had never touched a tulip bulb were trading these contracts multiple times per day, each time at higher prices, convinced that someone else would pay even more tomorrow. The social dynamics of the bubble are as important as the economic mechanics. Tulip trading moved from the formal flower markets into taverns and inns, particularly in smaller Dutch towns like Haarlem and Alkmaar. Groups called colleges formed, essentially drinking clubs where members would gather to buy and sell tulip contracts. These weren't sophisticated merchants or experienced financiers. They were weavers, carpenters, bakers, and other middle-class workers who saw their neighbors getting rich and wanted their share. The meetings had a festive atmosphere, with wine flowing and group pressure to participate. Refusing to join the trade might mark you as foolish or cowardly, someone lacking the vision to see the obvious profits everyone else was making. This social element created a feedback loop where rising prices justified themselves. If everyone around you is making money, questioning whether tulip bulbs are really worth a year's wages seems not just foolish, but financially self-destructive. What made ordinary people believe prices would keep rising forever? Several psychological factors converged. First was the recency effect. Prices had been rising for months, and human brains are remarkably good at projecting recent trends into the indefinite future. Second was the greater fool theory. Even if you suspected tulips were overpriced, you could profit if you sold to someone else before the music stopped. Third was the legitimacy provided by wealthy early buyers. If rich merchants and nobles were paying thousands for rare tulips, surely the market had genuine value. Fourth was the limited downside thinking. Many buyers put down small deposits on contracts rather than paying full price up front, meaning they felt they risked only their deposit, not the full contract value. This encouraged wild speculation because the perceived risk seemed manageable, even as potential rewards seemed unlimited. The crash, when it came, was swift and absolute. In early February 1637, at a routine tulip auction in Haarlem, buyers simply failed to appear. Some historians point to a specific auction where a lot of 99 bulbs failed to meet their reserve price. Word spread quickly through the trading networks. If buyers weren't showing up at auctions, who would honor all those contracts written in taverns? Within days, panic selling began. The problem was that in a futures market based on informal contracts and social trust, there were no actual enforcement mechanisms. Courts had already indicated they would treat tulip futures as gambling debts, unenforceable under Dutch law. This meant that when prices collapsed, buyers could simply walk away from their contracts. They would lose their deposits, typically 10 to 20% of the contract price, but they wouldn't be forced to pay the full amount for bulbs now worth a fraction of the contract price. The economic damage from the crash itself was probably less catastrophic than popular legend suggests. Recent historical scholarship has revealed that the truly astronomical prices, like the 10,000 guilder Semper Augustus, were rare exceptions rather than typical transactions. Most trading during the bubble involved more common bulbs, selling for prices that, while inflated, were measured in dozens or hundreds of guilders rather than thousands. The informal nature of the contracts meant that many transactions were simply voided, with losses limited to deposits. Dutch economic records from 1637 and 1638 don't show widespread bankruptcies or business failures that would indicate systemic financial collapse. The Dutch Republic continued its golden age, and Amsterdam's financial markets kept functioning normally. However, this relatively contained economic damage shouldn't minimize the real crisis that Tulip Mania represented. The bubble exposed fundamental vulnerabilities in how markets operate and how humans make decisions about value. It demonstrated that prices could become completely detached from any underlying value or utility. A tulip bulb doesn't produce income like a rental property or dividends like a share in a trading company. Its only value is what someone else will pay for it, making it a pure speculation. When markets become dominated by speculation rather than fundamental value, they become inherently unstable, prone to collapse at any moment when confidence falters. Tulip Mania also revealed how easily sophisticated financial instruments can be misused. Futures contracts are genuinely useful financial tools. Farmers can lock in prices for crops before harvest, reducing risk. Merchants can secure goods for future delivery, enabling planning. But in the tulip market, futures contracts became divorced from their practical purpose and turned into pure gambling instruments. The same contract might change hands 10 times in an afternoon, with each buyer hoping only to sell to the next person at a higher price. Nobody cared about actually receiving tulip bulbs. This transformation of a useful financial tool into a gambling chip would repeat throughout financial history.